Introduction: The New Empire. Power rarely disappears, it transforms. For most of human history, power meant controlling land. The ruler who controlled fertile soil controlled food. The one who controlled food controlled people. Empires rose and fell around territory, rivers, ports, trade routes. Then came industry. Coal replaced soil as the strategic asset. Steel replaced wheat as the symbol of dominance. Factories, railways, mechanized production, industrial empires emerged. Control of energy and production capacity defined global hierarchies. Then finance took center stage. Capital markets, banks, global liquidity networks, power shifted from factories to financial systems. Those who controlled capital flows shaped nations. Monetary policy became geopolitical leverage. Investment houses influenced industries. The architecture of finance became the architecture of influence. But today, we are witnessing another transformation. A quieter one. The most valuable resource of the 21st century is not land. It is not oil. It is not factories. It is data. And this is the new empire. From physical assets to invisible infrastructure. Data does not look like traditional power. It has no physical form, no borders, no visible weight. Yet it shapes behavior, predicts decisions, influences elections, directs capital flows, and steers attention. In previous centuries, power relied on controlling territory. Today, power increasingly relies on controlling information flows. Who collects it? Who analyzes it? Who monetizes it? Who restricts it? The battlefield has shifted from geography to algorithms. And unlike land, data scales infinitely. A piece of land can be owned by one party. A barrel of oil can be burned once. But data can be copied, processed, recombined, and leveraged endlessly. Its marginal cost approaches zero. Its strategic value compounds. The rise of data-driven power. When platforms understand your preferences, they predict your consumption. When algorithms map your attention patterns, they shape your behavior. When financial systems analyze your digital footprint, they assess your creditworthiness. When governments aggregate biometric, transactional, and social data, they model compliance. This is not theoretical. It is operational. Data has become the foundation of behavioral forecasting. And behavioral forecasting is power. Because if you can predict what people will do, you can influence what they will do. And if you can influence behavior at scale, you influence markets. Why data is more powerful than oil. Oil powered the Industrial Revolution. Data powers the digital one. But data differs from oil in one fundamental way. Oil fuels machines. Data fuels decisions. And decisions shape systems. Data informs. What products are recommended, which ads are shown, which news is amplified, which loans are approved, which investments receive funding, which political messages go viral. This makes data not just an economic asset. It is a cognitive asset. It influences perception. And perception shapes reality. The silent shift from capitalism to dataism. Traditional capitalism revolved around ownership of production. Factories, supply chains, infrastructure. In the digital age, ownership of data ecosystems increasingly determines dominance. Platforms do not just sell products, they extract behavioral signals, search history, purchase patterns, location data, social interactions. These signals become predictive models. Predictive models become monetized through advertising, pricing optimization, and behavioral nudging. This is not just commerce. It is the engineering of choice environments. When algorithms determine what you see, what you compare, and what you click, they influence the structure of your decisions. The more data a system collects, the more accurate its predictions become. And the more accurate its predictions, the more power it accumulates. This creates feedback loops. Data improves algorithms. Algorithms attract users. Users generate more data. Power compounds. The new inequality. In industrial capitalism, inequality centered around capital ownership. In the data economy, inequality centers around data ownership. Most individuals generate data. Few entities control it. Those who control large-scale data infrastructures possess asymmetrical insight into populations. They understand behavioral trends before others see them. They anticipate market shifts early. They shape digital ecosystems that guide attention. This asymmetry becomes economic leverage. In financial markets, information asymmetry has always mattered. But now, the asymmetry is structural and continuous. Investors in the age of data. For investors, this transformation is not abstract. Market behavior increasingly reflects algorithmic trading. Consumer trends emerge from platform analytics. Advertising budgets flow toward digital ecosystems. Corporate valuations increasingly reflect data assets rather than tangible ones. The question is no longer who owns the factories. It is who owns the behavioral pipelines. Who controls the cloud infrastructure? Who trains the models? Who governs the data flows? Because those who control these architectures influence economic direction. Sovereignty in the data era. In previous eras, sovereignty meant territorial integrity. In the data era, sovereignty includes informational control. If foreign platforms dominate digital ecosystems, influence flows outward. If data infrastructure is centralized, vulnerability increases. Nations, corporations, and individuals are now competing not only for capital, but for informational autonomy. And autonomy determines resilience. The central question. The emerging empire is not ruled by kings or industrial magnates. It is structured around algorithms, cloud servers, and predictive systems. Power is shifting toward those who can collect data at scale, process it efficiently, convert it into actionable insight, deploy it strategically. The implications are economic, they are political, they are psychological, and for investors, they are strategic. Because in every era, wealth accumulates around the dominant infrastructure. Land empires created aristocracies. Industrial empires created magnates. Financial empires created bankers. The data empire will create its own class of power brokers. The question is not whether this transformation is happening. It is how it will reshape markets and who will position correctly within it. In the next section, we step back and examine the historical evolution of power itself, from land to industry to capital to data, and why this transition is structurally different from everything that came before. Section 1. The History of Power. Land, Industry, Capital, Data. Power evolves with infrastructure. It does not disappear, it relocates. To understand why data is becoming the dominant asset of our time, we must understand how power has historically been structured. Each era was defined by the control of a strategic resource. Each transition reshaped economic hierarchies, political systems, and wealth accumulation. The pattern is consistent. Control the core resource to control the system to shape the future. Let us move chronologically. Land, the agrarian order. For most of human civilization, land was power. Agricultural productivity determined survival. Whoever controlled fertile territory controlled food supply. Whoever controlled food controlled populations. Empires such as Rome, the Ottoman Empire, and Imperial China were territorial systems. Expansion meant securing arable land, trade routes, and access to water. Land created static wealth. It could not be replicated, it could not be moved, it could only be conquered or inherited. Power in this era was visibly geographic. Borders defined influence. Armies enforced property. Political hierarchy mirrored land ownership. Economic structure was simple. Landowners to farmers to labor. Wealth concentrated in aristocracies. But land had limitations. Agricultural production scaled slowly. Population growth strained resources. Efficiency gains were incremental. Then came energy. 2. Industry. The energy revolution. The Industrial Revolution shifted the axis of power from land to production. Coal, steam engines, mechanization, energy multiplied output beyond biological constraints. Factories replaced fields as centers of wealth creation. Now, power belonged to those who controlled energy sources, manufacturing capacity, transportation infrastructure. Industrialists replaced aristocrats as dominant elites. Cities grew around factories. Railways reshaped geography. Steel and oil became strategic assets. Unlike land, industrial assets could scale. Production lines expanded. Machines improved productivity. Trade globalized. Wealth became dynamic. Capital was reinvested into machinery, innovation, and expansion. Industrial empires, Britain, Germany, the United States, rose not because of land size alone, but because of industrial capacity. Control of energy and production redefined geopolitics, but industry required financing. Factories, railways, oil rigs, they demanded capital accumulation. And thus began the next shift. 3. Capital, the financial order. By the 20th century, financial systems became the core infrastructure of power. Banks allocated credit. Stock exchanges priced future expectations. Central banks managed liquidity. Control of capital flows began to rival control of production. Finance became abstract leverage. A factory might produce goods, but credit decided which factories survived. Capital markets determined expansion capacity. Currency regimes shaped international trade. Interest rates influenced economic cycles. This was the age of financial capitalism. Investment houses, global banks, and institutional investors accumulated influence. Unlike land or factories, capital moved fluidly. It crossed borders instantly. It scaled exponentially. Wealth concentrated not just in industrial ownership, but in financial intermediation. Derivatives, leverage, securitization, financial innovation amplified reach. The system became increasingly complex. But capital, though abstract, was still rooted in tangible economic activity. Then something unprecedented happened. Information began to outpace capital. 4. Data, the informational order. In the digital age, power no longer rests primarily on controlling production or capital allocation. It rests on controlling information. Specifically, behavioral data. Every search query, transaction, click, movement, interaction, these generate signals. Signals become datasets. Datasets become predictive models. Predictive models shape markets. Unlike land, data scales infinitely. Unlike factories, data does not degrade. Unlike capital, data improves through usage. It compounds. The more users interact with a system, the more data is generated. The more data is generated, the better the algorithm. The better the algorithm, the more users it attracts. This creates feedback loops that previous eras never experienced. Land did not improve because more farmers used it. Factories did not automatically become smarter because more workers entered. But data systems improve through participation. They become self-reinforcing. This structural difference changes everything. 5. Why data is structurally different. There are 4 characteristics that make data uniquely powerful. Pyramide, non-rivalrous nature. Land is rivalrous. If one person owns it, another cannot. Data is non-rivalrous. Multiple actors can use the same dataset simultaneously. But control, not usage, is where power lies. Whoever controls aggregation, storage, and processing dominates. 2. Predictive capacity. Land produces crops. Factories produce goods. Capital produces investment returns. Data produces foresight. It allows systems to predict consumer demand, political behavior, credit risk, market volatility. Prediction reduces uncertainty. Reducing uncertainty increases leverage. 3. Network effects. Data systems strengthen with scale. The larger the user base, the stronger the model. This produces natural monopolies. Industrial monopolies required physical dominance. Data monopolies require platform dominance. Once scale is achieved, entry barriers rise dramatically. 4. Behavioral influence. Previous resources enabled production. Data enables influence. Algorithms determine visibility. Visibility shapes perception. Perception shapes behavior. Thus, data power extends beyond economics. It penetrates cognition. 6. The compression of time. Each historical shift accelerated change. Agrarian systems lasted millennia. Industrial dominance reshaped the world in centuries. Financial capitalism matured over decades. Data transformation is unfolding within years. The compression of time increases volatility. Systems evolve faster than regulatory frameworks. Power concentrates before oversight adapts. This asymmetry creates instability and opportunity. 7. Wealth in each era. In every era, the dominant infrastructure produced dominant fortunes. Land created dynasties. Industry created magnates. Finance created bankers and hedge fund titans. Data is creating platform architects, AI founders, infrastructure controllers. The pattern remains consistent. Own the core infrastructure implies accumulate disproportionate wealth. 8. The strategic implication. We are not witnessing a temporary trend. We are witnessing a structural transition. Data is becoming the backbone of economic organization. Cloud infrastructure replaces railroads. Algorithms replace assembly lines. Behavioral prediction replaces physical inventory management. The shift is not about technology alone. It is about power architecture. In the agrarian era, borders defined dominance. In the industrial era, energy capacity defined dominance. In the financial era, liquidity defined dominance. In the data era, informational asymmetry defines dominance. And informational asymmetry compounds faster than any previous asset class. The forward question. If power has moved from land to industry to capital to data, then the crucial question becomes, what does control of data actually mean in practice? How is it used to influence behavior? How does it reshape markets? How does it redefine sovereignty? And how does it create new forms of inequality? In the next section, we move from historical architecture to operational mechanics, how data becomes behavioral control. Because the future will not be controlled by those who merely collect data. It will be controlled by those who convert it into prediction and deploy that prediction strategically. Section 2. Data as behavioral control. If land controlled survival and industry controlled production and capital controlled allocation, data controls something deeper, behavior. This is the structural leap of the digital age. Data does not merely measure what people do. It predicts what they will do, and increasingly, it shapes what they do. The difference between prediction and influence is subtle, but decisive. When you can predict behavior with high accuracy, you can design environments that steer it. This is not conspiracy. It is architecture. 1. From information to prediction. In previous economic systems, information mattered, but it was fragmented and delayed. Merchants knew local demand. Bankers knew client balances. Governments collected census data periodically. Today, data is continuous, real-time, granular. Search queries reveal intent before purchase. Browsing time reveals interest intensity. Scrolling speed reveals emotional engagement. Location data reveals physical routines. Patterns emerge. Patterns become models. Models generate probability distributions. For every user, platforms estimate likelihood of purchase, likelihood of clicking, likelihood of churn, likelihood of political persuasion. This transforms markets into predictive systems, and prediction is leverage. 2. The rise of behavioral forecasting. Once behavior becomes predictable, it becomes monetizable. Digital platforms operate as behavioral forecasting engines. They do not simply show ads. They optimize probability. Every click is tested. Every layout is adjusted. Every color, notification, and timing is measured. A/B testing is not cosmetic experimentation. It is behavioral calibration. If a button increases conversion by 2%, it stays. If a notification timing increases engagement by 5%, it is deployed. Over time, these micro-adjustments reshape user habits. Habits become routines. Routines become dependency. Dependency becomes economic power. 3. Attention as the primary commodity. In the data economy, attention is currency. Human attention is finite. Platforms compete for it aggressively. Algorithms prioritize content that maximizes engagement. Engagement correlates with emotional activation. Emotion increases time spent. Time spent increases data extraction. Data extraction increases predictive accuracy. Predictive accuracy increases monetization. The cycle reinforces itself. Content is not necessarily optimized for truth. It is optimized for retention. Retention fuels data accumulation, and accumulated data fuels behavioral precision. 4. Algorithmic nudging. Behavioral economics introduced the concept of nudging, subtle design features that influence decisions without coercion. Digital systems scale nudging. Choice architecture is embedded into interface design. Default settings influence subscription rates. Autoplay influences viewing duration. Recommendation engines influence consumption patterns. Notification frequency influences engagement rhythms. These are not neutral tools. They structure decision environments. When a recommendation system presents options in a specific order, it shapes selection probability. When a feed algorithm amplifies certain narratives, it shapes perception. Choice still exists, but choice occurs inside designed architecture. Architecture is power. V. Data feedback loops. Behavioral control strengthens through feedback. Every action provides signal. Every signal refines the model. The more you interact, the more precisely the system understands you. And the more precisely it understands you, the more accurately it can predict and influence your next action. This creates a symmetry. You interact casually. The system analyzes structurally. You experience content. The system maps patterns. The feedback loop deepens silently. Unlike industrial power, which required visible infrastructure, data power operates invisibly. The control mechanism is embedded in interaction itself. 6. Financial implications. Behavioral data does not only influence consumer purchases, it influences markets. High-frequency trading algorithms process vast streams of market data in milliseconds. Sentiment analysis scans news feeds and social media. Retail investor flows are tracked in real time. Options positioning is modeled to anticipate volatility shifts. Market reactions are increasingly automated. Human traders compete with systems that detect micro-patterns beyond conscious recognition. This transforms capital allocation. It compresses reaction time. It magnifies informational advantage. Behavioral data in financial markets does not simply predict outcomes. It anticipates reactions. And anticipating reactions means front-running probability. 7. Political and social leverage. Data as behavioral control extends beyond commerce. Political campaigns use micro-targeting to tailor messaging. Voter behavior is modeled by demographics, browsing patterns, and social networks. Messaging can be personalized to psychological profiles. Two citizens may receive entirely different political narratives based on predictive modeling. This fragments public discourse. Shared information landscapes dissolve. Power shifts toward those who control distribution channels. Influence becomes individualized. Democracy becomes algorithmically mediated. This is not theoretical. It is operational architecture. 8. Surveillance capitalism. The term surveillance capitalism captures the economic model behind data-driven behavioral control. User activity is not merely participation, it is extraction. Every interaction generates data surplus. That surplus is sold, analyzed, or deployed to increase platform optimization. The product's not only the service offered, the product is the prediction of future behavior. And prediction markets are extremely valuable because whoever predicts accurately allocates resources efficiently, and whoever allocates efficiently dominates. 9. The illusion of neutrality. Algorithms are often perceived as neutral. They are not. They are trained on data. Data reflects past behavior. Past behavior reflects historical biases, economic structures, and social inequalities. Thus, predictive systems may reinforce existing asymmetries. Credit algorithms may favor profiles with historically stable income patterns. Content algorithms may amplify polarizing narratives because they increase engagement. Optimization is not morality. It is efficiency. And efficiency without oversight concentrates power. 10. The psychological dimension. Behavioral control does not require coercion. It requires probability adjustment. If a platform increases the probability of you watching certain content by 10%, that small shift compounds over time. Your worldview gradually aligns with amplified narratives. Your consumption patterns align with recommendation patterns. Your preferences adapt to curated exposure. The shift is incremental. But incremental shifts shape identity. And identity shapes long-term behavior. 11th, the strategic core. The strategic power of data lies in 3 stages. 1. Collection. 2. Modeling. 3. Deployment. Collection aggregates raw signals. Modeling converts signals into predictive probability. Deployment uses prediction to influence outcomes. Control of any one stage creates advantage. Control of all 3 creates dominance. This is why cloud infrastructure, AI development, and platform ecosystems converge. Data is not powerful alone. It becomes powerful when integrated into decision architecture. 12th, the new question of freedom. In earlier eras, freedom meant protection from physical coercion. In the data era, freedom increasingly concerns informational autonomy. If your preferences are predicted and nudged continuously, how autonomous are your decisions? If recommendation systems filter your exposure, how independent is your perception? These questions are not philosophical abstractions. They are structural realities of digital economies. 13. The investor's perspective. For investors, understanding data as behavioral control is critical. It explains why platform companies scale so rapidly, why network effects dominate valuation, why data infrastructure commands premium multiples, why algorithmic advantage compounds. Owning production capacity was strategic in 1900. Owning predictive capacity is strategic now, because prediction reduces uncertainty, and reduced uncertainty increases control. The emerging reality. Data is not just a resource, it is behavioral leverage. It influences markets, politics, consumption, identity. It operates invisibly. It scales infinitely. It compounds structurally. And those who control its architecture shape probability landscapes. In the next section, we go deeper. If data predicts behavior, what happens when artificial intelligence begins making decisions autonomously? What happens when algorithms do not just influence choice, but replace human judgment entirely? That is where decision sovereignty itself comes into question. Section 3. AI, Algorithms and Decision Sovereignty. Data predicts. Artificial intelligence decides. That is the next escalation. If data is the new resource, AI is the refinery. Raw signals become structured insight. Structured insight becomes automated action. Automated action becomes systemic influence. The shift from data to AI marks a deeper transformation than the shift from land to industry. Because this time, the transition is not only economic, it is cognitive. We are outsourcing judgment. 1. From recommendation to automation. At first, algorithms recommended. They suggested products. They ranked search results. They curated news feeds. Humans still decided. But as machine learning models improved, recommendations became increasingly precise. The next step was automation. Credit approvals became algorithmic. Insurance pricing became algorithmic. Fraud detection became algorithmic. Trading strategies became algorithmic. Gradually, machines moved from suggesting to executing. Human oversight remained nominal, but decision velocity surpassed human capacity. The speed differential alone created structural dependence. If AI reacts in microseconds and humans in seconds, the system defaults to automation. 2. Decision sovereignty. Defined. Decision sovereignty refers to the ability of individuals, institutions, and nations to make independent, informed choices. In previous eras, sovereignty was territorial. In the digital era, sovereignty becomes cognitive. If your financial decisions rely on algorithmic scoring, are they truly yours? If your news consumption is curated by predictive models, how independent is your perception? If your investment flows are influenced by automated trading systems, how autonomous are markets? AI increasingly mediates the informational inputs that precede decision-making. and whoever controls those inputs influences outcomes. 3. When machines know you better than you. Machine learning models excel at pattern recognition. They detect correlations invisible to human intuition. Shopping patterns reveal future needs. Typing speed reveals emotional state. Micro-expressions reveal intent. Transaction histories reveal behavioral consistency. Over time, predictive systems construct detailed behavioral profiles. These profiles often forecast decisions before individuals consciously articulate them. A system may predict you will default before you feel financial strain. It may anticipate a purchase before you believe you want it. It may assess political alignment before you define it. The asymmetry is structural. You experience your thoughts sequentially. The system analyzes your behavior probabilistically. Prediction precedes self-awareness. That is unprecedented. 4. Financial markets as AI ecosystems. Nowhere is AI's influence more visible than in financial markets. Algorithmic trading accounts for a substantial share of daily volume in major exchanges. These systems analyze order book dynamics, latency, arbitrage, sentiment shifts, cross-asset correlations. They operate continuously. They adjust exposure automatically. They optimize risk in real time. Human traders operate in hours and days. AI operates in microseconds. This asymmetry compresses decision cycles. Markets become ecosystems of interacting algorithms. Volatility can emerge not from fundamental shifts, but from algorithmic feedback loops. Flash crashes are examples of machine-speed interactions overwhelming human intervention. Decision sovereignty shifts from individual traders to code architects. V. Algorithmic credit and economic access. AI increasingly governs access to opportunity. Credit scoring systems analyze thousands of variables beyond traditional metrics. Insurance premiums adjust dynamically. Hiring algorithms filter applicants before human review. These systems claim objectivity, but they operate within training datasets. If datasets reflect historical inequality, models may perpetuate it. The opacity of AI systems compounds the problem. Many machine learning models are not easily interpretable. Decisions emerge from weighted neural networks rather than explicit rules. Thus, economic inclusion becomes partially dependent on opaque architectures. Those who design the systems shape opportunity landscapes. 6. The illusion of neutral optimization. AI systems optimize for defined objectives. Maximize engagement, minimize default risk, increase click-through rate, reduce churn. Optimization is powerful, but optimization does not imply fairness. An algorithm trained to maximize engagement may amplify polarizing content. An algorithm trained to reduce risk may exclude unconventional applicants. Optimization narrows focus. It does not widen perspective. And because AI scales rapidly, small optimization biases compound. This introduces a subtle shift. Decisions increasingly reflect the objectives embedded in code, not necessarily collective values. Control of AI objectives becomes political power. Septini, National AI Arms Race. Decision sovereignty also operates at the national level. Nations invest heavily in AI research, semiconductor production, and data infrastructure. AI influences military strategy, cybersecurity, economic competitiveness, public administration. The geopolitical dimension is clear. Control over advanced AI systems translates into strategic leverage. A nation that controls advanced AI chips, large-scale data centers, and training models possesses structural advantage. Economic growth rates may increasingly correlate with AI integration. Thus, sovereignty now includes technological capacity. Dependence on foreign AI systems creates vulnerability. 8. The human-machine boundary. The deeper question is philosophical. At what point does assistance become replacement? If AI systems optimize portfolio allocation better than humans, should humans override them? If AI diagnoses medical conditions more accurately, should human judgment intervene? Efficiency pressures favor automation, but autonomy requires participation. If individuals rely entirely on AI for decision-making, agency erodes. And with it, responsibility. Decision sovereignty requires maintaining the capacity to override automation. Without that capacity, systems drift toward technocratic control. 9. Investor implications. For investors, the AI shift has structural implications. Value creation increasingly centers around semiconductor manufacturing, cloud infrastructure, AI model development, data center capacity, enterprise automation platforms. AI integration reduces operational costs and increases productivity, but it also concentrates power in firms controlling infrastructure. Valuation multiples reflect this structural dominance. The companies training foundational models become gatekeepers. Gatekeepers shape ecosystems. Ecosystems generate recurring revenue. Recurring revenue compounds. Owning AI infrastructure resembles owning railroads in the industrial era. It is backbone ownership. 10. Autonomy versus convenience. Consumers trade sovereignty for convenience. AI assistants schedule appointments. Navigation systems optimize routes. Recommendation engines simplify choice. Convenience reduces friction. Reduced friction increases dependence. Dependence reduces autonomy. The trade-off is gradual. Most individuals do not notice the shift. But cumulative delegation reshapes agency. The question is not whether AI improves efficiency. It does. The question is whether efficiency gradually centralizes decision authority. 11th. The strategic core. AI transforms data into execution. Execution transforms probability landscapes. Whoever controls AI infrastructure shapes economic allocation, behavioral influence, political stability, market volatility. Decision sovereignty becomes a central theme of the 21st century. Not just who has data, but who operationalizes it. The next layer. If AI reshapes decision authority and data reshapes behavioral control, Then the next structural question becomes economic. How does this concentration of data and algorithmic infrastructure translate into monopolistic power? How do network effects in digital ecosystems create structural dominance? And what does this mean for wealth concentration? In the next section, we examine data monopolies and economic concentration, and why informational compounding may outpace every previous form of capital accumulation. Section 4. Data monopolies and economic concentration. If land concentrated power geographically, if industry concentrated power physically, if capital concentrated power financially, data concentrates power structurally. And structural concentration is the most durable form of dominance because it embeds itself into infrastructure. It becomes the operating system of the economy. 1. The architecture of data monopoly. Traditional monopolies relied on control of scarce physical resources, railroads, oil fields, steel production. Barriers to entry were capital-intensive but tangible. Data monopolies operate differently. Their dominance arises from 3 reinforcing mechanisms. 1. Network effects. 2. Scale economies in data processing. 3. Feedback loops of optimization. Each strengthens the other, and together they create near impenetrable economic moats. 2. Network effects, the gravity engine. A network effect occurs when a product becomes more valuable as more people use it. Social platforms illustrate this clearly. If everyone you know uses one network, switching costs increase. But in the data economy, network effects are not just social. They are informational. More users leads to more data, leads to better models, leads to better user experience, leads to more users. The platform improves because it learns faster. Learning speed becomes competitive advantage. New entrants face a structural disadvantage. They do not possess historical data at scale. Without data, models underperform. Without performance, users do not migrate. Without migration, data does not accumulate. This is gravity. Once scale is achieved, dominance becomes self-reinforcing. 3. Economies of data scale. In industrial systems, economies of scale reduced marginal production costs. In data systems, scale reduces marginal prediction error. The larger the data set, the more accurate the model. Accuracy improves user experience. User experience increases engagement. Engagement produces additional data. Data compounds. Unlike physical capital, which depreciates, data improves through use. A factory ages. A dataset refines. This inversion alters the structure of competition. The dominant platform does not merely defend market share, it accelerates ahead. 4. Data as infrastructure. Digital platforms increasingly resemble utilities. Search engines, cloud providers, payment processors, e-commerce marketplaces. These systems do not just participate in markets. They structure markets. If sellers rely on a dominant marketplace, that marketplace becomes gatekeeper. If developers rely on a dominant cloud provider, that provider becomes infrastructure. Gatekeepers extract rents. Infrastructure owners set standards. Standards determine dependency. Dependency reinforces monopoly. 5. Switching costs and lock-in. Data monopolies benefit from lock-in mechanisms. Your purchase history lives within one platform. Your social network resides within another. Your files are stored in a specific cloud ecosystem. Switching requires friction. Friction discourages migration. Moreover, ecosystems are layered. Messaging integrates with payment. Payment integrates with advertising. Advertising integrates with analytics. The more integrated the ecosystem, the higher the switching cost. Dominance becomes architectural. 6. Data as competitive intelligence. Data monopolies possess insight into entire sectors. They see consumer behavior patterns, price, sensitivity trends, search intent signals, demand fluctuations. This informational advantage allows them to anticipate market shifts. They may identify high-performing third-party sellers and replicate their products. They may adjust algorithmic visibility to favor internal offerings. They may acquire emerging competitors early. Control of data provides early warning systems. An early warning translates into strategic leverage. 7. The winner-take-most economy. In industrial capitalism, competition could fragment markets. Multiple automakers, multiple steel producers. In data capitalism, concentration intensifies. Because the best model attracts the most users. The most users generate the most data. The most data creates the best model. The loop favors incumbents disproportionately. Markets become winner-take-most. Even when alternatives exist, they struggle to match predictive accuracy. Predictive advantage translates into economic dominance. 8. Financialization of data dominance. Capital markets recognize this structural power. Data-driven firms often command higher valuation multiples. Why? Because recurring revenue streams become more predictable. Platform ecosystems generate subscription flows, advertising revenue, and transaction fees. Predictability reduces perceived risk. Reduced risk increases valuation. Furthermore, intangible assets dominate balance sheets. Brand, algorithms, user base, data repositories. Traditional accounting struggles to quantify data value. But markets price it implicitly. Wealth accumulates around intangible dominance. 9. Regulatory tension. Concentration attracts scrutiny. Governments examine antitrust implications. Questions emerge. Should platforms be broken up? Should data portability be mandated? Should algorithmic transparency be enforced? But regulatory frameworks were built for industrial monopolies. Data monopolies operate across borders. They scale faster than legislation. They evolve through software updates, not physical expansion. Regulation lags innovation. And lag sustains dominance. 10. Data colonialism. There is a geopolitical dimension. Some nations export data infrastructure globally. Platforms collect user data across continents. Behavioral insights centralize in corporate headquarters. Economic value concentrates where processing occurs. This creates digital asymmetry. Nations without sovereign data infrastructure become data suppliers rather than data owners. The analogy resembles resource extraction economies. Raw data is extracted. Value-added modeling occurs elsewhere. Profit flows outward. Control concentrates inward. 11th, the illusion of free services. Many dominant platforms offer services at zero monetary cost. Search is free. Social networking is free. Email is free. But the currency is data. Users trade behavioral signals for access. The transaction is implicit. The data collected fuels predictive systems. Predictive systems monetize at scale. Free services lower barriers to adoption. Adoption accelerates data accumulation. Data accumulation reinforces monopoly. 12th, compounding informational asymmetry. Data monopolies do not merely grow revenue, they grow knowledge. Knowledge compounds asymmetrically. The longer the platform operates, the deeper its historical dataset. Historical datasets enable longitudinal modeling. Longitudinal modeling increases predictive accuracy. Predictive accuracy enhances strategic foresight. Foresight improves capital allocation. Improved capital allocation reinforces dominance. Compounding is not only financial, it is informational. And informational compounding may be more powerful than capital compounding. 13. The investor's strategic view. Investors must recognize that data monopolies represent structural moats. Owning infrastructure in the data era resembles owning railroads in the 19th century. Backbone assets generate recurring flows. However, concentration introduces fragility. Regulatory intervention, technological disruption, geopolitical fragmentation. Dominance is durable, but not immune. Investors must weigh scale advantages, regulatory risk, technological obsolescence, geopolitical tensions. The reward for infrastructure ownership is significant, but the systemic risk must be understood. 14. The structural outcome. Data monopolies reshape economic concentration. Wealth centralizes around platform architects. Mid-tier competitors struggle. Small players become dependent on ecosystem rules. Power becomes algorithmic rather than territorial. The result is a layered economy. Infrastructure owners, platform operators, application developers, users. Each layer depends on the one above, and the upper layers capture disproportionate value. The next question. If data monopolies concentrate economic power, how does this reshape financial markets directly? How do algorithmic systems influence pricing, liquidity, volatility, and retail behavior? And what happens when behavioral extraction becomes integrated into capital allocation itself? In the next section, we examine financial markets in the age of data and how informational asymmetry reshapes investment strategy itself. Section 5. Financial Markets in the Age of Data. Financial markets have always been information systems. Prices reflect expectations. Expectations reflect information. Information determines capital allocation. But the nature of information has changed. In previous eras, markets responded to earnings reports, macroeconomic data, policy decisions, and analyst research. Today, markets ingest continuous streams of behavioral signals. The shift from periodic information to real-time data has transformed market structure itself. 1. From fundamental analysis to data-driven reflexivity. Traditional investing centered on fundamentals, revenue growth, profit margins, balance sheet strength, competitive advantage. These metrics still matter, but they are increasingly supplemented and sometimes overshadowed by data flows. Search trends anticipate demand shifts. Social sentiment predicts retail flows. Transaction data reveals consumption patterns before earnings releases. Hedge funds analyze satellite imagery to estimate store traffic. They scrape web data to track pricing changes. They monitor shipping data to predict supply constraints. Information advantage now includes alternative data. Alternative data narrows reaction time. The faster you detect shifts, the earlier you reposition. Markets become anticipatory. 2. High-frequency trading and machine speed. High-frequency trading, HFT, represents the most visible manifestation of data dominance. These systems analyze order books in microseconds. They exploit price discrepancies between exchanges. They respond to market signals before human traders can perceive them. Latency becomes competitive advantage. Milliseconds translate into millions. In this environment, traditional reaction time is obsolete. Human discretion operates at a different speed than machine execution. Markets evolve into algorithmic ecosystems. Algorithms trade against algorithms. Volatility can be generated by machine interaction rather than human emotion. The architecture becomes self-referential. 3. Behavioral data as market fuel. Retail participation has increased dramatically in recent years. Mobile trading apps lowered barriers. Commission-free models democratized access. But retail activity generates data. Order flow data reveals positioning concentration. Options flows indicate sentiment extremes. Short interest metrics signal potential squeezes. Large funds monitor these patterns continuously. Behavioral extraction extends into trading itself. Retail enthusiasm becomes tradable signal. Momentum amplifies reflexively. Narratives spread digitally. Price action accelerates. Data is not just observing markets, it is shaping them. Четверти. Information asymmetry, два пика нула. Financial markets have always contained asymmetry. Insiders possessed information advantages. Institutional investors accessed better research. But today's asymmetry is structural and automated. Large institutions possess real-time data ingestion pipelines, massive computational capacity, machine learning models trained on decades of market history. Retail investors operate with delayed interpretation. While a retail trader reads an earnings summary, an algorithm has already processed the filing and adjusted positions. The informational gap widens. Technology magnifies scale. Scale magnifies advantage. V. Market efficiency in the data era. Paradoxically, increased data can increase both efficiency and fragility. On one hand, markets incorporate information faster. Mispricings correct quickly. Arbitrage windows narrow. On the other hand, synchronized models amplify systemic risk. If multiple funds deploy similar strategies, crowding increases. When volatility spikes, algorithmic deleveraging triggers simultaneous selling. Liquidity evaporates rapidly. Flash crashes illustrate how automated feedback loops can overwhelm markets. Efficiency compresses time. Compressed time increases fragility. Gestais, sentiment amplification. Digital platforms accelerate narrative contagion. News spreads instantly. Commentary multiplies across social networks. Market sentiment becomes visible in real time. Sentiment analysis tools quantify tone. Bullish mentions, bearish mentions, engagement velocity. Funds incorporate these metrics into trading strategies. Narrative becomes input variable. Markets become partially narrative-driven. Price moves not only because of earnings, but because of collective belief intensity. Belief measured digitally becomes tradable asset. 7. Passive flows and algorithmic allocation. Index funds and passive investing have reshaped capital allocation. When money flows into index funds, capital distributes automatically across constituents. No discretionary judgment intervenes. Algorithmic weighting determines allocation. Large firms receive proportionally larger inflows. This reinforces dominance. Capital concentration mirrors index structure. Data-driven portfolio construction further automates this process. Risk parity models rebalance mechanically. Volatility targeting strategies adjust exposure based on quantitative triggers. Human discretion recedes. The market becomes more rules-based. Rules are coded. Coding is centralized. 8. Retail manipulation and information cascades. Data asymmetry also creates opportunities for exploitation. Platforms can identify which retail segments are most responsive to certain narratives. Marketing campaigns can target specific behavioral profiles. Derivative positioning can be influenced by sentiment waves. Information cascades amplify price swings. When early buyers push momentum, social reinforcement accelerates participation. Algorithms detect volume surges. Liquidity providers widen spreads. Volatility expands. Markets become emotional accelerators. Data tracks. Emotion. Emotion drives price. Price feeds back into emotion. The cycle intensifies. 9. The rise of predictive capital. The ultimate advantage in financial markets is predictive capacity. If you can forecast consumer behavior, supply chain disruptions, liquidity, shifts, sentiment extremes, You allocate capital preemptively. Data infrastructures make prediction systematic. AI models simulate probability distributions continuously. Risk becomes statistical landscape rather than intuition. Capital allocation becomes increasingly automated. The winners are those who own predictive engines. 10. Structural concentration of alpha. Alpha, excess return, traditionally emerged from insight. Today, alpha increasingly emerges from infrastructure. Computational power data acquisition pipelines, proprietary algorithms, low latency connectivity. These are capital intensive. Small funds struggle to compete. Performance converges toward those with superior systems. Infrastructure becomes performance driver. This mirrors earlier eras. Industrial scale determined output. Financial scale determined liquidity. Now data scale determines prediction. 11th. Regulatory and ethical questions. As AI-driven strategies proliferate, questions emerge. Should algorithmic trading be limited? Should data access be equalized? Should market structure prioritize stability over speed? Regulators struggle to keep pace. Technology evolves faster than policy. The tension between innovation and stability intensifies. Markets increasingly depend on systems few fully understand. 12th. Investor strategy in the data era. Investors must recognize that markets are no longer purely human arenas. They are hybrid ecosystems. Human psychology still matters, but machine psychology, algorithmic response patterns, matters as well. Strategic positioning requires understanding. Infrastructure ownership. AI integration data. Monetization models. Systemic risk triggers. In earlier eras, investing meant understanding factories. Today, it means understanding data pipelines. 13. The structural conclusion. Financial markets in the age of data operate at machine speed, incorporate behavioral signals continuously, and reward predictive infrastructure. The edge has shifted from information access to information processing. Processing capacity determines foresight. Foresight determines allocation. Allocation determines wealth concentration. Data has not just entered markets, it has reshaped their architecture. And as markets become increasingly automated, a deeper geopolitical question emerges. What happens when states use data not only to influence markets, but to shape entire societies? In the next section, we examine the tension between digital authoritarianism and digital freedom, and the future battle over informational sovereignty. Section 6. Digital authoritarianism versus digital freedom. If data predicts behavior, if AI executes decisions, if markets internalize algorithms, then the ultimate question is political. Who controls the system? Digital power does not remain confined to markets. It extends into governance. In the 20th century, political control required physical surveillance, bureaucratic reach, and coercive force. In the 21st century, it can operate through data architecture. The tension between digital authoritarianism and digital freedom will define the next geopolitical era. 1. What is digital authoritarianism? Digital authoritarianism refers to the use of digital infrastructure, data collection, AI systems, biometric monitoring, predictive analytics to increase centralized control over society. Unlike traditional authoritarian systems, which relied heavily on overt repression, digital control can be subtle. Behavior can be nudged before dissent forms. Access to services can be conditioned on compliance. Narratives can be curated algorithmically. Social networks can be monitored continuously. The control mechanism shifts from physical coercion to informational dominance. And informational dominance scales more efficiently. 2. Surveillance as structural power. Modern digital systems generate constant data streams. Location tracking, facial recognition, transaction history, online speech patterns. When aggregated at national scale, these signals create detailed behavioral maps. Governments with access to such infrastructure gain predictive visibility into population dynamics. They can identify emerging movements. They can track dissent networks. They can model risk clusters. Predictive governance reduces uncertainty. Reduced uncertainty increases centralized power. The key distinction from past eras is automation. Monitoring does not require thousands of officers reading reports. It requires algorithms scanning for anomalies. Tries, social scoring logic. The concept of social scoring, where behavior influences access to credit, services, or opportunity, illustrates the fusion of data and authority. If financial reliability, social compliance, and digital reputation become interconnected, individual autonomy narrows. Behavior influences score. Score influences access. Access influences opportunity. The system becomes self-reinforcing. Citizens adjust behavior preemptively to maintain standing. Compliance becomes algorithmically incentivized. In such systems, control does not require visible force. It requires access to data infrastructure. CBDC, Central Bank Digital Currencies, CBDCs. One of the most consequential developments in digital governance is the rise of central bank digital currencies. CBDCs represent programmable money. In theory, they increase efficiency and transparency. In practice, they introduce new capabilities. Transaction tracking becomes direct. Spending restrictions become programmable. Monetary stimulus can be conditional. Money becomes data native. This does not automatically imply authoritarian control, but it expands the state's capacity. Capacity creates possibility. Possibility reshapes power balance. The difference between oversight and control becomes architectural rather than philosophical. Platform power versus state power. Digital authoritarianism does not only arise from governments. Private platforms possess enormous informational influence. They shape speech visibility. They moderate discourse. They curate information flow. When a small number of corporations control digital ecosystems, they wield quasi-sovereign influence. The boundary between corporate governance and public governance blurs. States regulate platforms. Platforms influence populations. Both compete for informational authority. This dual structure complicates sovereignty. Control over digital infrastructure becomes as strategic as control over territory. 6. The illusion of neutral infrastructure. Digital infrastructure is often framed as neutral technology, but infrastructure encodes rules. Algorithms prioritize content based on defined objectives. Identity verification systems define acceptable participation. Payment systems determine financial inclusion. Infrastructure shapes opportunity landscapes. Control over infrastructure shapes society. Neutrality is often an illusion. Optimization choices reflect underlying values. Who defines those values? That is the political question of the digital age. 7. Digital freedom, a competing vision. Digital freedom represents the counterbalance. It emphasizes data ownership rights, encryption, decentralization, transparency, interoperability. Rather than centralizing control, digital freedom distributes it. Blockchain-based systems attempt to decentralize financial authority. Open source AI seeks to reduce centralized model dominance. Data portability regulations aim to weaken platform lock-in. The objective is informational sovereignty at the individual level. But decentralization has trade-offs. Efficiency may decline. Coordination may fragment. Security may become complex. The tension between control and freedom reflects trade-offs between stability and autonomy. 8. The geopolitical divide. Different nations approach digital infrastructure differently. Some prioritize centralized efficiency and surveillance capacity. Others emphasize privacy protections and decentralization. The result is digital bifurcation. Separate ecosystems emerge. Different regulatory regimes govern data flows. Cross-border data exchange becomes politically sensitive. Digital trade agreements become strategic instruments. The next geopolitical conflicts may revolve less around territory and more around semiconductors, AI models, and data governance standards. 9. Economic implications. For investors, this tension shapes capital allocation. Cybersecurity becomes strategic asset class. Cloud sovereignty initiatives create regional infrastructure demand. Semiconductor supply chains become national security priorities. Companies aligned with state objectives may gain protection or subsidy. Conversely, firms caught between geopolitical blocs face regulatory friction. Digital fragmentation introduces risk, but also opportunity. Infrastructure ownership in aligned jurisdictions becomes valuable, but exposure to politically sensitive markets increases volatility. 10. Freedom, efficiency, and the trade-off. Digital authoritarianism promises efficiency. Predictive governance reduces friction. Algorithmic enforcement increases compliance. Digital freedom preserves autonomy, but autonomy may introduce inefficiency. The trade-off between convenience and sovereignty becomes central. Citizens may prefer frictionless services, but frictionless systems often centralize control. Over time, small trade-offs compound. Architecture shapes outcome. 11th, The structural reality. We are entering an era where informational control defines political leverage. Data monopolies influence markets. AI systems influence decisions. Digital governance influences behavior. The question is not whether data will shape the future. It already does. The question is, who controls the architecture? States, corporations, or individuals? The balance among these forces will determine the character of the 21st century. The final strategic question. For investors and strategic thinkers, the implications are clear. Infrastructure ownership matters. AI capacity matters. Cybersecurity resilience matters. Regulatory alignment matters. The next layer of analysis moves from systemic tension to personal positioning. If data defines power and AI defines leverage, how should individuals and investors position themselves? What assets benefit from this structural shift? What risks must be hedged? In the final section, we translate informational power into strategic allocation. Section 7. Strategic positioning for investors. If land created aristocracies, if industry created magnates, if finance created bankers, the data era will create infrastructure architects. The question is not whether data reshapes power. It already has. The question for investors is simple. Where does value concentrate in a data-driven world? And how do you position accordingly? 1. Own the infrastructure, not the noise. Every structural shift rewards those who own backbone assets. In the industrial era, railroads, steel, and energy infrastructure dominated. In the financial era, clearing systems and capital networks dominated. In the data era, backbone ownership includes cloud computing infrastructure, data centers, semiconductor manufacturing, AI model development platforms, cybersecurity networks. These are not consumer fads. They are systemic enablers. Applications come and go. Infrastructure compounds. Investors who understand this distinction avoid speculative surface trends and focus on structural layers. 2. Semiconductors. The new oil wells. Advanced AI systems require computational power. Computational power requires advanced chips. Chip design and fabrication have become geopolitically strategic industries. High-performance GPUs, AI accelerators, and advanced lithography systems are scarce and capital-intensive. Barriers to entry are immense. The firms that dominate advanced semiconductor manufacturing occupy leverage positions within the global economy. They sit at the intersection of AI expansion and geopolitical strategy. Owning exposure to this layer means owning exposure to the foundation of AI development. 3. Cloud sovereignty y data centers. Data requires storage and processing. Cloud providers operate as the modern equivalent of utilities. They host enterprise software, AI training models, financial systems, and public infrastructure. As digital fragmentation increases, demand for regional cloud sovereignty grows. Nations seek localized data control. This increases demand for regional data centers, cybersecurity infrastructure, edge computing systems. Cloud infrastructure generates recurring revenue. Recurring revenue compounds. Backbone assets tend to be durable. 4. Cybersecurity as structural necessity. As data centralization increases, vulnerability increases. Cybersecurity becomes non-optional. In previous eras, physical security protected factories. In the digital era, encryption and network defense protect infrastructure. Cybersecurity firms benefit from rising regulatory requirements, increased attack surfaces, geopolitical cyber tensions. Unlike discretionary spending categories, cybersecurity is defensive capital expenditure, and defensive spending tends to persist through economic cycles. Investors seeking resilience must recognize this layer. V. AI platforms and model gatekeepers. Beyond hardware and cloud infrastructure, AI model developers represent a strategic layer. Foundational AI models trained on massive datasets require enormous capital investment. The firms controlling these models become gatekeepers. They license capabilities. They define access terms. They integrate into enterprise workflows. This resembles operating system dominance in previous technological eras. Gatekeeper platforms command ecosystem leverage. However, investors must monitor regulatory scrutiny. Concentration invites intervention. Position sizing must account for political risk. Chest. Decentralization as hedge. Digital concentration increases systemic fragility. When power centralizes, counter-movements emerge. Blockchain systems, decentralized finance, privacy-preserving technologies, these represent attempts to rebalance sovereignty. While volatile, decentralized infrastructures may serve as hedge exposure against centralized control. Not every decentralized project will survive, but the underlying demand for autonomy will persist. Selective exposure may offer asymmetric upside. 7. Data ownership and personal strategy. Strategic positioning is not only about equity exposure, it is also about informational sovereignty. Individuals should consider where their data resides, which platforms they depend on, how diversified their digital footprint is. Over-reliance on a single ecosystem increases vulnerability. Diversification in digital identity reduces systemic risk. In the same way that investors diversify capital, they should diversify data exposure. Estuntas. Geopolitical allocation. The data era is not borderless. AI supply chains are geographically sensitive. Semiconductor fabrication depends on specific regions. Cloud infrastructure reflects regulatory regimes. Capital allocation must consider geopolitical alignment. Exposure to strategically aligned jurisdictions may reduce systemic disruption risk. However, fragmentation also introduces volatility. Geopolitical tension is structural, not cyclical. Long-term positioning requires awareness of global supply chains and digital alliances. 9. Avoiding surface-level speculation. In every technological shift, speculative bubbles form. Not every AI startup will dominate. Not every data-driven platform will survive. The majority of early entrants disappear. infrastructure endures. Focus on balance sheets. Focus on recurring revenue models. Focus on technological defensibility. Focus on capital allocation discipline. Hype cycles are short, structural moats are long. 10. Risk management in the data era. The same forces that create opportunity create concentration risk. Data monopolies face regulatory action, public backlash, technological disruption, cyber vulnerability. AI systems may introduce unforeseen liabilities. Investors must evaluate downside asymmetry. Concentration can compound wealth. It can also amplify fragility. Diversification across infrastructure layers reduces systemic exposure. 11. The strategic core insight. Every era concentrates value around its dominant infrastructure. The agrarian era rewarded landowners. The industrial era rewarded energy and production magnates. The financial era rewarded capital allocators. The data era rewards predictive infrastructure owners. Data is not a theme. It is a structural transition. AI is not a trend. It is a compounding force. Cybersecurity is not optional. It is foundational. Investors who recognize these layers position themselves within the architecture of the new empire. 12th, final reflection. Power has migrated from land to machines to capital to data. Data refines into AI. AI integrates into infrastructure. Infrastructure defines sovereignty. Sovereignty shapes markets. Markets determine wealth. The question is not whether this transformation will continue. It will. The question is whether you position passively, reacting to headlines, or structurally, aligning with backbone assets. Those who understand that informational infrastructure compounds faster than physical capital will navigate the next decade differently. Because in the new empire, control of data is not merely economic advantage. It is systemic leverage. And systemic leverage determines who shapes the future.